replacing some steel beams and slabs of concrete. This past couple weeks have been a microcosm of the markets this whole year. Record highs on Monday wiped out over the next couple of days. First Financial's Kirk Copenhaver talks with Courier Market Engagement Director Kelly Snyder about whether the presidential election is playing a role.
So, Kirk, it's been about a month since you've been here, and the election has come and gone. Did the market respond like you had hoped?
Well, one thing we really try to avoid doing is trading on political events, really for two reasons. One, they're getting harder and harder to predict. And two, the market impact is rarely what you think it would be. If you look at 2016, for example, Donald Trump was running on a platform that touted deregulation and also reviving manufacturing in America. After its victory, the sectors that you would think would most benefit from this agenda, energy and financials from deregulation, and then industrials and materials from the manufacturing side, really outperformed over that first month. But after that, the sectors that were supposed to benefit most from his agenda were actually some of the worst performing sectors for the remainder of his term. So the takeaway here really is that it's difficult to trade on political events because things rarely play out exactly as you would expect.
If you don't adjust your outlook based on the election, how have you been positioning your client portfolios?
Yeah, so one of the themes we've been talking about over the last couple months is the idea of a reflation reset, where rising interest rates, rising inflation, and a weaker dollar really start to influence the market. Since the election, it appears that the market's beginning to come around to this idea. I mean, you just look at the yield on the 10-year Treasury, it's up pretty significantly since bottoming at 0.6% in August. Also, there's optimism building around COVID vaccines being available sooner rather than later, which would lead to the economy reopening and activity really picking back up. Also, investors seem okay with the potential for divided government. It's important to remember that gridlock in Washington is usually pretty good for stocks as long as nothing really needs to get done. So assuming Washington can hammer out another fiscal stimulus package, a divided government should be pretty good for stocks going forward.
Interesting. So what else are you seeing in the markets right now?
We think we could be seeing the start of a leadership rotation away from growth stocks and into more cyclical value stocks. Heading into the pandemic, broadly speaking, earnings growth was slowing and more difficult to come by. So investors really bid up the shares of those companies that could provide that earnings growth. You're looking at the Fab Five: Microsoft, Apple, Google, Facebook, and Amazon, plus a few others here and there. Then, during the lockdown, those again were some of the same few companies that could reliably deliver that precious earnings growth in this new kind of COVID economy. And this led investors to drive up their prices and valuations even higher. But as growth becomes easier to come by in 2021, with the economy presumably opening back up and companies lapping those trough earnings levels from earlier this year, growth should be fairly easy to come by. So usually in this scenario, investors typically start selling their expensive growth stocks and start to go bargain shopping among cheaper value issues that can now deliver some of that earnings growth. And this is how the value rotation usually plays out. And we're beginning to see it happen now with the recent relative outperformance of the Russell 1000 Value Index versus the Russell 1000 Growth Index. And that's really being driven by financials, industrials, and commodity-oriented companies.
Wow. Well, thank you so much for the update, and thanks for being here. We look forward to seeing you in about a month or so. So have a great day.
Yeah, you too.